The scale of the move mattered less than the speed. When roughly $4 trillion of market value was repriced in just over a day, the headline reaction focused on recovery. What was missed was the signal embedded in how that repricing unfolded and which assets responded first. Markets reprice constantly. What makes this episode different is compression. 30 hours is not enough time for fundamentals to change meaningfully, for earnings expectations to reset, or for macro data to justify a broad reassessment of value. When repricing happens that fast, it is rarely about new information. It is about old assumptions being stress-tested. In that window, precious metals behaved differently from the rest of the system. Silver and gold adjusted quickly, not because they were leading a rally, but because they were responding to a change in confidence rather than a change in outlook. That distinction matters. Confidence repricing tends to surface before narrative repricing. It shows up in assets that are sensitive to liquidity conditions, balance sheet stress, and trust in financial intermediation. Precious metals sit at the intersection of those forces. They are not purely risk assets, and they are not purely defensive. They react when the market quietly reassesses what it is willing to assume. The prevailing interpretation framed the move as a rebound from excess pessimism. That framing is comfortable because it implies restoration. It suggests the system corrected itself and moved on. But restoration requires symmetry. What occurred was asymmetric. Certain assets absorbed the repricing more smoothly than others. Some segments regained liquidity rapidly, others lagged, even as headline indices recovered. This uneven response is often overlooked, but it is where structural signals emerge. Silver's adjustment was not about enthusiasm, it was about recalibration. In compressed repricing events, metals often function as pressure gauges rather than directional bets. They respond to shifts in funding conditions, collateral confidence, and risk tolerance among large participants. Those shifts rarely announce themselves directly. This is why focusing solely on percentage gains misses the point. The magnitude tells you how much moved. The sequencing tells you why. In this case, precious metals did not wait for confirmation from equities or macro narratives. They responded as assumptions were being quietly revised. That behavior suggests the repricing was less about optimism and more about reassessment. For professionals and researchers, this distinction is critical. Markets that rebound on improved expectations behave differently from markets that rebound on reduced stress. One restores confidence, the other exposes fragility. If you follow markets to understand structure rather than sentiment, consider subscribing. This analysis focuses on how confidence shifts propagate through systems, not just where prices land. The key question now is not whether the repricing was justified, but what it revealed about the underlying mechanics of the market. To answer that, we need to examine why precious metals were positioned to respond so quickly, and what that says about where stress was concentrated. Rapid repricing events are not distributed evenly across markets. They flow through existing fault lines, amplifying signals where assumptions are most fragile. In this case, precious metals responded early because they sit closest to the boundary between financial abstraction and physical constraint. Silver and gold are often described as hedges, but that label is imprecise. They are better understood as instruments that react to changes in trust. When funding conditions tighten, when collateral quality is reassessed, or when liquidity becomes selective, metals tend to move before broader narratives adjust. This is because metals are not dependent on forward-looking growth assumptions. They do not require confidence in earnings, policy effectiveness, or economic expansion. Their value is anchored in continuity. When the market questions continuity, even briefly, metals register that hesitation. The 30-hour repricing window compressed multiple layers of adjustment into a single sequence. First came de-risking, as positions were reduced and exposure trimmed. Then came stabilization, as liquidity was reintroduced selectively. Finally came repricing, as participants reassessed which assumptions still held. In that sequence, metals acted as early responders, not because they were being chased, but because they required less narrative justification to reprice. Their reaction reflected a shift in how risk was being carried, not where growth was expected. This is a subtle distinction, but it explains why metals can move alongside both risk-on and risk-off behavior. They are not directional in the traditional sense. They are conditional. The market often misinterprets this behavior. When metals rise quickly, it is framed as fear or speculation. When they lag, it is framed as irrelevance. Both interpretations miss the underlying function. Metals respond to the integrity of the system, not to sentiment about outcomes. During rapid repricing, integrity is questioned implicitly. Participants are not asking whether the economy will grow. They are asking whether positions can be maintained without friction, whether funding will remain available, whether assumptions about liquidity are still valid. Silver's behavior in this context was particularly informative. Unlike gold, silver straddles industrial necessity and financial abstraction. Its response reflects both demand continuity and financial sensitivity. When silver reprices early, it suggests stress is being registered across multiple layers of the system. Importantly, this does not imply crisis. Markets can question assumptions without breaking them. But the act of questioning itself changes behavior. Exposure is managed more cautiously. Time horizons shorten. Flexibility is valued over conviction. These changes are not immediately visible in price charts. They appear in sequencing, in which assets move first, in how quickly liquidity returns, in which markets require reassurance and which do not. Understanding this helps reframe the repricing. It was not a simple recovery from excess pessimism. It was a test of resilience. Precious metals passed that test by responding efficiently to changing conditions. Other assets required more time. To understand the implications of that difference, we need to examine how such repricing events alter market behavior beyond the initial window, and why the after-effects often matter more than the move itself. What follows a compressed repricing is often more revealing than the event itself. Once markets stabilize, attention shifts away from speed and back toward interpretation. This is where misreadings tend to persist, because the visible stress has passed while the structural adjustment remains. After a rapid repricing, participants do not simply return to prior behavior. They reassess which assumptions proved reliable and which required revision. This reassessment is selective. Some beliefs are reinforced, others are quietly downgraded. The market does not announce these changes. It incorporates them into behavior. In the case of this $4 trillion adjustment, one of the most important reassessments involved liquidity confidence. The speed of the move revealed how quickly risk could be withdrawn and redeployed, but it also exposed how dependent that process is on coordinated participation. Liquidity returned, but it did so conditionally. Conditional liquidity behaves differently from abundant liquidity. It appears when needed, but it is not offered indiscriminately. Market depth looks sufficient until it is tested. Volatility remains contained until alignment breaks. This environment is stable, but it is less forgiving. Precious metals continue to matter in this phase because they respond not just to stress, but to how stress is managed. When markets reprice rapidly and then pause, metals often reflect whether confidence has been fully restored or merely deferred. Silver's behavior after the initial adjustment suggested the latter. The repricing occurred quickly, but follow-through was measured. That combination is characteristic of markets operating under revised assumptions. Participants are no longer reacting reflexively. They are observing whether conditions warrant renewed exposure. This observation period is often misinterpreted as indecision. In reality, it is calibration. Markets are testing whether the new equilibrium can be maintained without further intervention. They are watching funding markets, collateral flows, and participation patterns for confirmation. During this phase, narratives tend to simplify. The move is framed as a recovery. The numbers are cited as proof, but structural signals are rarely contained in summaries. They persist in relative behavior, in cross-market responses, and in the sequencing of risk. The fact that precious metals adjusted early and then stabilized rather than accelerating suggests that the repricing addressed immediate stress without resolving longer-term questions. That distinction matters. Markets that fully resolve stress tend to re-expand risk aggressively. Markets that merely absorb stress remain cautious. Caution is not bearish, it is adaptive. For professionals and researchers, this is where attention should remain. The aftermath of a repricing tells you how much confidence was restored and how much was withheld. It reveals whether the system believes the adjustment was sufficient or merely necessary. The key insight is that rapid repricing events do not reset markets. They recalibrate them. The calibration influences behavior long after the headlines fade. To understand how this recalibration shapes future responses, and why its effects often surface later rather than immediately, we need to examine how confidence, once narrowed, is rebuilt or further constrained. Confidence, once narrowed, is rarely restored all at once. It is rebuilt selectively, and that selectivity shapes how markets respond to subsequent information. After a rapid repricing, participants do not ask whether prices are fair. They ask whether the system will behave predictably if tested again. This distinction is subtle but critical. Predictability, not valuation, underpins confidence in modern markets. Following the 30-hour repricing, evidence suggested that confidence had stabilized but not fully reset. Liquidity returned, but it did so unevenly. Some segments absorbed flows smoothly. Others required reassurance. This unevenness is not a flaw, it is a signal. When markets operate with full confidence, responses to new information are broad and coordinated. When confidence is conditional, responses become fragmented. Different participants react at different speeds. Different assets require different thresholds before engagement resumes. The market remains functional, but alignment weakens. Precious metals often reveal this fragmentation because they sit outside the core growth narrative. They do not rely on optimism to attract participation. They rely on trust in continuity. When that trust is only partially restored, metals tend to reflect caution even as broader markets appear calm. This is why post-repricing behavior matters more than the repricing itself. It shows whether participants believe the adjustment resolved underlying stress or merely postponed it. In this case, behavior suggested postponement rather than resolution. Markets continued to trade, but with heightened sensitivity to marginal signals. Small changes in funding conditions drew attention. Cross-asset correlations fluctuated more than expected. Risk was carried, but it was monitored closely. This monitoring phase is often mistaken for normalization. In reality, it is evaluation. Participants are watching for confirmation that the system can absorb additional strain without repeating the adjustment. Until that confirmation arrives, behavior remains conservative. This conservatism influences how markets interpret subsequent moves. Positive developments are welcomed but not extrapolated aggressively. Negative developments are contained but not dismissed. The response function has changed. Importantly, this phase can persist for extended periods without visible stress. Markets may drift higher, volatility may remain low, and narratives may regain confidence. Beneath that surface, however, assumptions have been revised. The $4 trillion repricing forced the market to acknowledge how quickly conditions can change when assumptions are tested. That acknowledgement does not disappear. It becomes part of the collective framework through which future information is processed. For professionals and researchers, this is the lasting impact. Repricing events recalibrate expectations about system resilience. They adjust the boundaries of what is considered plausible. They influence how much risk participants are willing to carry without confirmation. Understanding this helps explain why markets sometimes react strongly to seemingly minor developments after a period of calm. The reaction is not about the development itself. It is about the context created by prior adjustment. To complete the picture, we need to examine how these recalibrated expectations influence longer-term market behavior, and why precious metals often continue to play a signaling role even after the initial stress has passed. The lasting impact of a rapid repricing is not measured by where prices settle, but by how the market behaves afterward. Once assumptions are tested at speed, the system does not forget. It incorporates that experience into future decision-making, often in ways that are subtle but persistent. This is where the deeper market shift becomes visible. After the $4 trillion repricing, markets did not revert to their previous posture. They resumed activity, but with altered priorities. Risk was carried, but more selectively. Liquidity was available, but less automatic. Confidence returned, but it was conditional. That conditionality is the key signal. Markets that have fully resolved stress tend to expand risk aggressively. They extrapolate improvement. They reward conviction. Markets that have merely absorbed stress behave differently. They remain functional, but they place greater emphasis on flexibility, timing, and optionality. The goal shifts from optimization to resilience. Precious metals continue to matter in this phase because they sit outside the optimism loop. They do not require a growth narrative to justify participation. Their role is not to predict outcomes, but to reflect how comfortable the system is with its own assumptions. The behavior of silver and gold following the repricing suggested that the market had stabilized without fully restoring trust. There was no urgency to exit, but no eagerness to overextend. This is characteristic of systems operating under revised assumptions rather than renewed confidence. Importantly, this does not imply fragility. It implies awareness. Awareness changes how information is processed. Data that would have been ignored before now carries weight. Timing becomes more important than magnitude. Sequencing matters more than headlines. The market listens more carefully to early signals and reacts more cautiously to late ones. This is how structural shifts take hold, not through dramatic breaks, but through incremental changes in behavior that compound over time. Participants learn what assumptions can be relied upon and which require validation. That learning reshapes the market's reaction function. The $4 trillion repricing compressed that learning into a short window. It forced the system to acknowledge how quickly confidence can be withdrawn and redeployed. That acknowledgement does not fade simply because prices stabilize. For professionals, academics, and researchers, this is the enduring insight. Markets are not misbehaving when they become more selective. They are adapting. They are internalizing information about their own limits. The deeper shift exposed by precious metals is not about direction, it is about tolerance. How much uncertainty can the system carry without demanding adjustment? How much reliance on abstraction is still comfortable? How quickly must assumptions be revisited when conditions change? These questions now sit closer to the surface. As a result, future repricing events may not need the same scale to produce reaction. Sensitivity has increased. The system requires less force to reassess. That does not make outcomes more predictable. It makes signals more valuable. This is why focusing on structure rather than sentiment remains essential. Price moves tell you what happened. Behavior tells you what changed. If this analysis has helped clarify why the speed and sequencing of the repricing mattered more than the headline numbers, consider sharing it with others who study markets through institutional and structural lenses. And if you've observed similar patterns, where rapid adjustment led to lasting behavioral change, add your perspective in the comments. These observations often reveal more than any single data release. The market did not simply recover, it recalibrated, and precious metals were among the first to reflect that shift.